This is the first of 6 parts for Chapter 8, so welcome. We begin by refreshing our memories about topics we've discussed before. And we've discussed filing status before, and we know that there are 4 filing statuses, but if you're married, you're either going to be married filing joint or married filing separate. And if you're unmarried, you're head of household or single. These filing statuses are going to affect the amount of tax you pay and the rate schedules that you use. We know that the rate schedules are used when income exceeds $100,000 or the tax period's less than 12 months. But for our purposes, we're always going to use the schedules. The tables, as you see here, are quite cumbersome, and so we're not going to be using these in this class. Here's the rate schedule for a single taxpayer, and we've seen this before. We know that today, in the after-tax reform era, the top rate on a taxpayer, whether single, married, head of household, or married filing separate, is 37%. And the lowest rate is 10. And we have these incremental progressive rates. We also know the same rates apply to married filing joint, and that for the most part, there is equity between married filing joint and single, in the sense that the married filing joint is often twice the amount of a single taxpayer. This slide compares the rates that existed before tax reform with those that are currently in effect after tax reform. And we notice that the rates have come down and that some of the brackets have been made a little bit wider. We can see the same thing for married filing joint. The rates came down and some of the brackets are a little bit wider. This is a calculation for someone's ordinary income tax, so their taxable income in this instance is $170. There's no special items. We'll look in special items in just a moment. So the calculation is really quite straightforward. We're going to find the appropriate bracket. In this case, 170 falls right between the 165 and the 315. And as a result, we're just going to take that marginal difference, which is $5,000, multiply it by the appropriate marginal rate, which is 24%, and then add that to the base. This $28,179 represents the tax on income of $165. So it's the cumulative effect of all the earlier brackets. Now there are some special rules that apply to certain types of income. We're first going to be looking at capital gains, but dividends have the same rates. You can see that same rate structure, 0, 15, 20. And capital gains actually, we'll get to some recapture provisions. We'll see that in some instances, capital gains can also be taxed at 25 and 28. We're not going to deal with that in this particular chapter. We will hold that till Chapter 7. Dividends, then, likewise, are taxed much the same as long-term capital gains. In another segment, we'll discuss kiddie tax as well as the AMT. The rates, as we said, for long-term capital gains and dividends is 0, 15, and 20%. The breakpoints are shown in this slide, depending on your filing status. So married filing joint has a breakpoint up to 77.2, has a 0% rate, and for most taxpayers between 77.2 and 479,000, there's a 15% rate, and then for those in the upper bracket, you can see it hits 20%. So it's still a progressive rate schedule that increases as income goes up. And for our purposes, most taxpayers are actually going to have 15 or 20, but some children or other individuals without a lot of income will occasionally benefit from that 0% bracket. And our focus is going to be on the married filing joint and single, since those are the rate schedules we've been looking at closely. As I alluded to, there is some special provisions that apply to capital gains that can create rates of 25 or 28%. These will be looked at in another chapter, so let's hold them off for now. We've got this example where we have a married couple, and you always want to pay attention to the filing status. They have ordinary income of 95 too, and they also have these capital gains and losses. Now the rule for capital gains and losses, which we'll see again in Chapter 7, is really quite straightforward. We're going to net short-term gains with the short-term losses, and in this instance we get $5,000. And then we'll net the long-term gains with the long-term losses. And we'll, in here, this example, we have 9,000. This is positive, and this is positive. As a result, we can't net these two numbers together. You couldn't net 5 with 9 because they're both gains. If one were a loss and one were a gain, we could continue netting. But at this point, we just have two positives. Now, the short term is going to be taxed as ordinary income. It's the long term that receives the favorable treatment. And hence, that's why we say it's possible that it's at a 0, 15, or 20% rate. We're also told that they have itemized deductions of $25,000. So now we want to calculate their tax. We start with their ordinary income, and we're going to add in any other special items they might have. We were told that they had short-term capital gains and long-term capital gains. We add that together, and then we're going to subtract out their standard deduction or itemized deduction, whichever is larger. And that would give us their taxable income. Now, some of their income is preferential. The long-term capital gain is eligible for a lower rate than the remaining portions of their income. So we're going to separate their income into the two components. The component that will be taxed as ordinary and the component that will be favorable and given favorable tax rates. So we've got the 75,200, and on that 75,002, we're simply going to apply the rate schedules that we've seen before. So we see that it falls now in the marginal rate of 12% because that 75,200 is right between 19,050 and 77,400. So we're going to calculate out the tax, and you can see we just bring this right down here. We're going to calculate the marginal tax rate for this couple, and their ordinary tax is $8,643. Now, the confusing part for many students is how to calculate the tax on the $9,000 of capital gain, or dividends would be the same calculation. We first of all are going to look at what would be the breakpoints. And we can see that breakpoints for a married couple, 0% rate applies for any income up to 77,200. Well, their income is only 75,200. So they're $2,000 off that breakpoint. So $2,000 of that capital gain is going to be eligible for that 0% rate. That, of course, leaves, if we subtract 2,000 out of that 9, that means the $7,000 would be then taxed at 15%. We can see that right here. So together, we're going to separate the 9,000 into its components and tax them at the appropriate rate. The total tax is then $9,693. Here we have another example. In this instance, we have a single taxpayer with ordinary income of $436 and the following gains and losses. We net short-term gains with short-term losses and long-term gains with long-term losses. In this instance, we have a loss. We have a negative number for our short, and we have a positive number for our gains. So we can go ahead and net that short-term loss against the long-term gain, and we end up with a $6,000 net long-term capital gain, which will be eligible for the preferential tax rate. We're also told that T is going to claim a standard deduction. Now it's time to calculate his tax. We start by just following the tax formula. And so we've got the ordinary income, the net long-term capital gain, as well as the standard deduction. So his taxable income is $430,000. We want to separate the preferentially taxed income from the income that would be taxed at ordinary rates. So we see the ordinary rates will apply to $424,000 of income. We then look to our rate schedule for a single taxpayer, and we can see his marginal rate is 35%. So all the income above $200,000 will be taxed at 35%, and the first $200,000 will be taxed with at $45,690. So we can see that calculation right down here. We're taking the marginal amount of income times multiplying it by that 35%, plus we're adding the tax on the base of $200,000. So we get the total tax of $124.90 on ordinary income. Now the question is how to tax that $6,000 of preferential income. To our breakpoints for capital gains and preferential income. The breakpoint for a single taxpayer between a 15% rate and a 20% rate occurs at $425,800. And in this instance, he had ordinary income of $424,000, which means there's still another $1,800 of income that's eligible for the 15% rate. So we can see that calculation right down here. He has 6,000. 1,800 is going to be taxed at 15%, which means then that 4,002 it will be taxed at 20%. We can see how that is separated out into the components. In this example, we have a married couple again, and their income is less than before. It's $100,000 ordinary income. They also have the following gains and losses. And I'm going to make some changes here because I noticed on the next slide there's some errors. So for the sake of consistency, let's just change a few of these numbers here. It'll make it easier on the next slide. So in this instance, there's 5,000 of short-term gain and 1,000 of loss. So our net will be $4,000, not $3,000. And here we'll have $6,000 of net long-term capital gain. Since this is a gain and this is a gain, we cannot actually net them together. So we'll have 6,000 of preferential income and 4,000 of ordinary short-term capital gain. So it's taxed at ordinary rates. We're also told itemized deductions are $15,000. All right, let's again change these numbers so that they work to our calculation. So we have $100,000 ordinary. We have the $10,000 of capital gain, both short and long. So 110 is the AGI. We subtract out now a standard deduction rather than the itemized because the standard is larger. And we have taxable income of 86. We separate the 86 into its preferential components, which you can see this slide needed that 6,000. So 6,000 is the preferential component and 8,000 is ordinary. We calculate the tax on the ordinary. We have a married couple, so we look to the rates for married filing joint. We take that 8,000 and we find where does it fall, and it's in now the 22% bracket. So we calculate the tax on the income. 22% is the marginal rate on the $2,600 of income, and their total ordinary tax then is $9,479. We then want to think about what's the appropriate rate for the $6,000. We looked at the breakpoints, and in this instance, we can see that the breakpoint is at $479,000 to hit the 20%, and the 15% breakpoint was at $77,200. Well, $80,000 is already above the $77,200, so clearly they're in the 15%, but they're not anywhere close to the $479,000. So in this instance, it's quite simple. They're simply going to have a flat 15% rate that applies to all of their preferentially taxed income. So $6,000 at 15% is the $900. So we can see that right there. Dividends are taxed similar to long-term capital gain. But before we get into the taxation on dividends, let's just first of all make it clear that they have to actually be paid out of earnings, either accumulated earnings and profits or current earnings and profits, either one. And the concept of earnings and profit is really like retained earnings. So in other words, the company needs to be making money and paying a dividend out of that income in order for it to be considered a dividend. Now, historically, dividends were always taxed just like any other sort of ordinary income, such as interest. But since 2003, they've received preferential treatment. They've been in parity with long-term capital gain tax rates. However, dividends have to be qualifying in order to receive that favorable treatment. So qualifying dividends are those paid by domestic and certain foreign corporations, and the shares have to be held for a required period of time. So again, they're paid out of earnings by domestic and certain foreign corporations. And the holding period is not particularly difficult. We look at the ex-dividend date, which is the date that follows after the company makes that declaration that they're going to pay a dividend, and then they name the date on which the shares will no longer be trading with the dividend. And then there's that date of record right after the ex-dividend date where they take toll of who's eligible for the dividend, and then they make their payment. So on that ex-dividend date, we're going to go 60 days out in both directions, and the shares must be held for 60 days within a 121-day period. So you have to buy the shares sometime before the dividend to be eligible for the dividend, and then you have to hold it 60 days after you buy them. For preferred stock, we simply lengthen that period. So now within a 181-day period, the shares must be held for at least 90 days. As part of the Affordable Care Act, there were some additional taxes that were added, and these are healthcare related taxes, although they are paid through the income tax system. So we now have some surtaxes. We have some high income surtaxes. We have a 3.8% tax on net investment income, and we also have a 0.9% Medicare tax for wages or self-employed income when it's high enough. So let's look at how these rates apply to the highest bracketed taxpayers, those with the most income. We know that the rate on ordinary income was brought down to 37% for top bracketed individuals, and wages and interest are both considered ordinary income. Dividends and capital gains, we also note, are preferentially taxed, and so they typically face rates of 0, 15, or 20%. And we noted that occasionally long-term capital gains will face rates of 25 or 28%, but we're going to save that for another chapter. We also know that anyone who's earning wages is subject to Medicare tax of 1.45%, and that for self-employed individuals, it's twice that amount. The surtax, as we mentioned on the previous slide, is 0.9% on high-income wages, and there's also a net investment income tax of 3.8% that applies to any source of investment income. So collectively, we can actually see that the rates are not all the same, and that certain types of income pays a substantially lower rate. As you can see, wages are rather punitively taxed, and interest is in fact the worst form of income in terms of its tax burden. Whereas dividends, which is often a corollary to investment interest income, is taxed much more favorably, as are long-term capital gains. That concludes this component, so thanks for viewing.